Hey guys, it's Max. How's everybody doing? I don't know why the screen's so messy. I mean, it shouldn't be. It looks like it's blurry or something. I don't know. Anyway, it's fine. I'll figure that out on my own time. All right. Just got done with the dog birthday party. One of my Jackson's best friend, it turned 10. So I just got done with that. But anyway, let's talk about ULTY and let's talk about all of ULTY, and we'll also talk about LFGY. It just started trading today. So let me share the screen. Let's look at the charts first and kind of see how the market ended up on the day. But we're going to go to ULTY and LFGY, and we'll talk trades and stuff. Jackson, what are you doing? I pulled up stock index futures. That's a daily chart. Jackson, please knock it off. What are you doing? Jackson, no. No. No, sir, Jackson. Jackson, you just got to eat a birthday cake, a dog birthday cake. You ought to be fine. Okay, well, you can see the market's gone straight sideways from where it opened. That's the 3 o'clock close. I believe JP Morgan had earnings. I was at the dog park all afternoon. I did pull this chart up when I got home. And it looks like if earnings were after the bell, it looks like things are good. What does it say right there? Next earnings report tomorrow. Okay, so it hasn't happened yet. All right, well, that's fine. That's fine. Well, that makes sense. So we're still in limbo on that. Let's check the Qs. Qs basically traded sideways today. They left a morning gap, a bullish gap behind this morning, but they invalidated it early on. So it's most likely that's bearish. And sure enough, it traded sideways. They have a couple of bearish gaps above serving as resistance right now and a bullish gap below. So the Qs are kind of trapped. We'll see. My bet is they visit 490, 495, 490 sometime soon, but just a guess. I could be totally wrong. All right, so that's the Qs. And then we have Russell, that's the weakest of the bunch. However, it showed signs of life today, and that's important. That's a 30-minute chart. That's important if you looked at the daily chart, because on the daily chart, Russell is right near a key area, the difference between a bull market and a bear market, the 200-day moving average. Well, the bulls took a stand and saved it for now at the 200-day moving average. We wouldn't want the Russell to drop into a bear market. Last time that happened was September of 23, September and October of 2023. That was pretty rough. I remember that one. That knocked the high yield funds down quite a bit. But anyway, then we had a hellacious rally after that. So we'll see. But for now, the bulls made a stand. And if you look at the SPY is still well above their 200 period moving average, and they're still in this bullish supply, or they're this bullish support. And then, of course, the Qs. I realize I just showed you the Qs, but these are daily charts, and the Qs are relatively stronger than either one of them right now, and well above their 200-day moving average. So anyway, all right. Now, I know you guys probably want to see the ULTYverse. So we'll start the ULTY grid. Now, I forgot to do the thing where I'm going to take a picture. And, well, in other words, because the chart is programmed to update every night. But what I want to do is be able to look at a running, the last couple of days of totals. Now, this is the allocation right here. This is what percentage of the fund we have. I said bonds today for this FGXXX. It's not bonds. It's a money market. I apologize. But I think that's come down a little bit. I think earlier when I called it bonds, I think it was more like around 8. Anyway, it's come down. I forgot to snapshot the the graph before it all changed. As soon as I put the new data in, I lost the old data because it's one anyway. That's my own problem. But this would be really interesting and more engaging if we could have last night's above it and then the night before, or below it, and we could look and compare. But I promise I'll do it. I promise I'll do it next time. But in any event, okay, so you can see, we can also look over here at the actual numbers. DJT is still pretty low at 1.36. Cash is 2.04, so cash is 2. Money market, FGXX, is 6. So between the two, if they're like cash-like or I don't know. Anyway, 8%. So you could say they're 92% invested right now. Maybe that's all we need to look at is just keep track of the invested level. I think I'm going to start keeping track of that. In any event, okay, so we put a new fund in here. We put BlackRock in. Well, that's the only one I noticed. But it's like playing that game where you have to, when you're a kid, where you memorize which cards there are and you have to turn over a card. What's that old game called? There's a game where it relied on your memory of being able to recall, where was that Jack of Hearts at? Anyway, I think these are all the same old ones we've had every day. I do these every night. I did it kind of fast today because of the dog birthday, and I didn't check it as thoroughly as I should have, but we had all those last night. I mean, I'm looking at them right now. Jay did, UNH, because I always make the joke about Jay's trading on people's pain and sorrow or whatever. It's just because they have high vol right now because they're in the news. That's all there is to it. Same thing with BLK. I mean, that's BlackRock. He added a BlackRock position, for gosh sake. So check this out. I thought you guys might be interested in actually what he did. So here it is. That's the profit and loss graph at expiration. He bought 7,000 shares. Now I want to check that. I want to check my own work. I thought it was 70,000 maybe, but it's right here. No, it's not right there. It's not right there. I have been remembering to save the old trade, so I can go back and look at yesterday's trade if I want to or something. I've been making, okay, so right there it is. Doesn't say BlackRock, but no, it's 7,000 shares. Oh, and that's the price. I didn't catch that before. Okay. Well, anyway, that's good. I'm glad we caught that. So, gosh darn it. 967. Okay. I switched the cost basis. Okay. So here is the position that they're in. They have 7,000 shares. So they're long shares. It's, about $315,000 worth. And we can also see in the ULTY allocation what percentage of that portfolio that is, but that's about what the overall investment is. Okay, so what they've done is they've turned around and they as soon as they bought stock, this is called a buy right. They bought stock and they simultaneously sold a call. Well, they sold the 1,000 strike call option. They received 354 for it. I think that was it. Let's check that. 354. They sold it 70 times, or 70 lots. SS means sell short. Now, SS, sell short, that just when people talk about short, that just means when you're selling something you don't already own. If it just says S, that's selling something, so that means something you already own. Without even looking, I can tell you that's reversing that B right there. When you buy something, you have to reverse it. Boom, that's sell. Or when you SS something, you have to sell short. You have to buy. But in any event, BC is what happens. After you SS something, you have to BC something. You sell something short, you have to buy to close it. And you buy something, you just have to sell it. Well, anyway, So then he turned around with part of the money. Think about that. If that's $354, and Jay's Trader made that times 73, so pretty nice payday. But then turned around and spent about $1.60 of it on something else. But anyway, but still, you could put $2 in your pocket. $200 times 70, times 10 would be 2,000. Anyway, so decent payday. So let's look back over here at the option simulator, the trade. Let's make sure I have the put. Yeah, $1.61. I think I missed it by a little bit. Okay, so this is the position, Jay's in. He can only lose a limited amount. And he can only make a limited amount. Above 1,000, he's capped. Below 920, there's no more possibility of loss. And the whole trade was done for a $13,000 credit, a little bit more. So something else. So this is the way this is just a standard caller. This is the way he does all the ULTY trades. But to me, if you look at what he's done, he's created a situation where he can basically have the same profit loss percentage as stock. That's the same as stock right there. If we put another line on there, if it was just stock, it would be the same. But what he's done is he's done a stock trade with a fence on it, with where he can't make unlimited, but he can't lose unlimited either. But basically, it's just a stock trade, because what he'll do is he'll probably roll this early. So basically, this is what he's playing for. If the market's up, he'll make 120,000 if it's up that much. If it's down that much, he'll lose 120. It looks like it's pretty much equidistant. The chance of profit's about 47%. He does get a credit for doing this trade, which he'll pay out as in the form of a dividend, but it's still just a bullish bet on this stock, period. You want higher prices. Now you get paid to wait for them, and $13,000 is a lot for 3 days, And should this stock go up, I mean, JP Morgan has earnings tomorrow. I bet BlackRock has earnings also. In fact, I know they do, but this isn't a show about earnings or whatever. But the banks all have earnings at the same time, right at the first of the season. Or maybe theirs was today. Whatever the case is, Jay, I'm promising you, is trying to take advantage of. They think that this number's way too high. So anyway, should be interesting to see what happens. So I saved that as the ULTY trade. I could save that. I could share that with you guys. I don't think you guys be that interested in it. But if you are interested in my channel, I did put a link to my Discord in the thing. And if you want to ask a question, I'll take questions here in a little bit. But I want to talk about LFGY. I know you guys want to hear about LFGY. But first I want to cover, so that's the only new trade we have in the Ultiverse is BlackRock. All right. So let's go back to the Ultiverse. Now, of course, this was more interesting when the market was trading, but I guess this is how we ended up today. So DJT down 8 today, 8%. It had a big up day yesterday, just a little profit taking, I'm sure, no big deal. The worst otherwise was Dollar General down 3%. Other than that, it was a pretty good day, especially when you consider how it started. I mean, it was also you have to I like that ULTY was up 48 bips for the average stock, because these really are stock plays at their core, believe it or not. I mean, yeah, it's an option play. I just showed you, there's some option income coming in, but the trade itself is basically a bullish stock trade. So market goes up, this thing will rage. Market goes down, it won't do so well, just like stock. But it's like stock with the floor on it. So, I mean, that, that's good. But the strategy did really well today because ULTY outperformed the stock price of ULTY outperformed the average constituent. So that's good to see. Now, you guys want to look at LFGY? So I pulled the trades for LFGY, or the positions. I guess the positions, and I guess I just pulled the, I have, no, I'm sorry, just the positions. I'm starting a sheet just like the other one, and I should have been more organized. But on this one, we really will. I'll just screen cap that and paste that picture of that so we can look and see how the allocation changes from day to day. All right. So let's see what's in the portfolio. Applied Digital. Okay. APLD. BTDR. BitDeer Technologies Group. Okay. What's that one? Canaan Inc. 30,000 shares. Now, on Applied Digital, he has on a covered call. BitDeer's a covered call. Canaan is a covered call. Cipher Mining just owns stock. CleanSpark just owns stock. Oh, I'm sorry, CleanSpark owns stock, short call, so that's a covered call. Coinbase owns stock, short call, long call above short call, so that's a covered call spread. That's the yield. That's the the yield max strategy. Core Scientific, okay, covered call. Hive Digital. I mean, these sound like great companies that I wish I had 1,000 shares of all of them, a year ago. I bet you there. I mean, anyway, Hive Digital. I mean, never heard of it, but I'm sure it's awesome. He has covered call. Robinhood, of course, covered call. Hut 8, I've heard of that one. I have no idea what they do. Okay, so then we have some IBIT, just some, I guess, some Bitcoin Trust, but with the covered caller spread. That's nice. Now, I think these numbers are wrong. I doubt he really has 932 puts. Do you think? I mean, I'm betting it's maybe 90 puts or 93 puts or something. Surely not. I don't know. We'll look at that one tomorrow. That, because usually the way you would do that, and you guys know, or if we haven't talked about it, I can put one of these in the simulator. In fact, I was going to do that. Anyway, it's not that big of a deal, but it looks like these are basically the same strategy, basically, that Yield Max does. I haven't seen any callers in here like you get in ULTY. So on Riot, he had on a covered call, and Block, he has on a covered call. Well, anyway, this should be interesting. So here's what I did. I'm trying to start, since this sheet is fresh. What I did is I have the stock, and then I have the percentage that stock's in the portfolio. Then I have the today's change. So APLD was up 9% today. Now, then what I'm trying to do is I'm trying to multiply that 9% times 3% of the portfolio and get the weighted performance. But anyway, I'll have to, I'm still ironing out some kinks here. But all right, where did I put this chart? Not that chart. You know what? I think I neglected to do this chart. I think this is a pretty good. This is what you want right here. Sorry about that. I appreciate your patience. I thought I did this one. So we are going to insert a chart there, and we're going to see today's change, basically. So that's not the weighting. That's just, so is that serious? That can't be right. So I probably have a formula wrong. I probably have a formula wrong. There's no way every stock in that sample was up. Well, one thing is, what is NU? I've never heard of that, but you want to talk about a risky sounding stock. It has like Cayman in the name. I mean, listen to this one. I mean, no, I wish everyone the best that invest in this, but for a small part of your overall portfolio, yeah, this is probably a great one to add in a little yield. This thing's probably going to be incredible. But New Holdings, LTD, Cayman Islands. I just thought that sounded scammy. I don't know. Anyway, I'm glad you guys are here. I was just checking in to see. It looks like Danger's here. Hey, Danger. Hey, Dan. I'll check back in with you guys a little bit. I'm just making sure I'm sharing the screen. Everything's going all right. Yeah. So what do you guys think about LFGY? I love the symbol. I mean, they're, LFG, that's anyway. Okay. So, but I did want to do this one other thing real quick here. All right. Well, so there's the chart. Well, that's incredible. There's, like I say, it's almost no way. NVIDIA, I did notice it was down today because NVDY was down in my account, and I noticed NVIDIA was. NVIDIA and NU, are you serious? NU, I was thinking today, I was cracking myself up. NU, someday someone's gonna be going, man, I never understood why I invested in that company. NU, never understood. I don't know, it's kind of a dad joke, but I could see it if it goes bad. All right. I cracked myself up. All right, so let's look at some other stuff. Let's get to how about the buffer report? Let's do some index buffering. How about that? We'll look at charts in a little while. I do want to look at a chart on NU, but that I was just kind of joking. I mean, I'm sure it's the best company in the world. I'm just joking. All right. I said a few years ago that you would never hear the word blockchain again. I predicted that like in 2019 because it was just so overused. And I thought it was jargon that didn't really mean anything. But people don't say that word that much. But the technology, whatever, definitely still here. All right. Shows you what I know. Look at this. You got to love some XFall, and that's killing it today, up 1%. Looks like the index didn't move much at all. The SPY was only finished the day up a fraction. So I don't know that any of these all look exaggerated because the SPY barely moved. I mean, we can see XVOL, ZVOL, CEPI had good days. I put LFGY on here. It's not showing up yet. It won't show up until tomorrow. It has to have a day before its change will show up. And I used the Qs for the underline for LF. I could have used Russell also, and I should have probably used maybe IBIT or maybe a Bitcoin trust for the underline. Maybe that'd been better. Over here on Maxi, boy, Eclipse killing it lately also. I think I finally took Maxi off. I was tired of Maxi messing up the scale, but now we have all these other ones on here. But CEPI, FEPI, and then we're going to look at LFGY, and I put AUPI right next to it. I know you guys like that. AI is not really, DeFi and crypto, but it's all over there in the same spot. You got to love old triple QI, just killing it, made 27 bips. That's good. Look, triple QI, BQDTE. It doesn't happen that often, but it does occasionally. Y triple Q beat both of them. Look at this. This is a good chance to hedge. If you had an 80-20 portfolio, 80% in one of the long ones, QDT, triple QI, any of the long ones, pick one. And then 20% in Y triple Q. I'm not suggesting that, but if you did, everything was up today. The only reason I mentioned that is I ran some back tests with that allocation, but I was not recommending it necessarily. All right, so let's see what else is going on. ULTY had a good day. It looks like it underperformed its benchmark, but I'm using the benchmark of ULTY as the Russell. That's probably what I ought to use for LFGY and SEPI's benchmark also, is really because it's more, that'd be more accurate. They're probably going to be down here tomorrow with the Russell stocks. And I'm going to have to put Maxi back on here since you guys are into it. Look at IWMY blowing out the parent. So anyway, that's a good performance. Let's see. Let's go over here to Yield Max land. Well, the good news, Coney getting all the upside of the parent, as well as JPMO. I mean, you know, Misty, unfortunately, just got about 80% of the upside, but it still got 3.2%. So GDXY only got about 95% of the upside. PP only got about 60%, unfortunately, but it still made 2.3% today. That's huge. Snowy, and it seems like it does this a lot. Snowy is not old enough to be on the retirement simulator. Neither are a lot of them. But as they turn a year old and their birthdays are all coming up, the retirement simulator and the max factor will shuffle around quite a bit. And I wouldn't be at all surprised to see some of these other ones jump up on here. But I really like Sky. Sky is a perennial. Sky does really well on just most any metric that I put on it, as does AMZ and NV, of course, NVDY. But anyway, but there's some younger funds that also do pretty well. I wouldn't be surprised if some of these younger ones get in that type of category. PLTY, my gosh, I mean, look at PLTY outperforming the parent. Okay, now on the downside, we only had one beating the parent on the downside, YMAG. You know, and I guess YMAG was down because Tesla was down. It looks like Tesla was down 1.7. Well, and NVIDIA was down. So, you know, the only good thing you can say about MRNY is they plenty of buffer. If you're just in it for the income, it still hurts. I mean, I get you, it still hurts. But all right, and AMZY unfortunately beating the parent on the downside, but I mean, heck, that's not down enough to really call that anything. It's not significant. All right, so the max factor, like I was going to say, this is the latest run. I run these numbers about once a week, so I go back a year about once a week, and then I get new numbers. But we're going to do a January run, and I've had somebody help me on the side, and they made a bunch of improvements to it, to the retirement simulator and to the max factor. So anyway, be looking for that. Okay, so I wanted to talk. I'm going to take a few questions, but then I wanted to talk about a back test real quick. But let's see what you guys have to say. I don't know on LFGY if I'm feeling it. I mean, for me, no, for me, but I'm just super duper conservative. I mean, I showed you my fund before. I mean, but heck, I'm not saying I would never put LFGY in there. I really need to do some. Okay, when I did my fund, I was basing it on max factor and the funds that have been out for a year. That's why I have Sky and NVDY, and I have great funds, AMZY, and it's great stuff, greatest stuff ever. But yeah, there's better funds out now. And so I'm really thinking, I have so much duplication. I'm really thinking about going to it's 20% ULTY, leaving it 20% ULTY, and then putting 20% YMAX, and then 20% feet. And that's 60%, but that covers the yield max universe. Okay, but then I still have 40%. And yes, I was thinking about maybe 20% in AI, maybe, or I've talked before about doing 20% in YQQQ in an inverse. I'm not saying I'm going to do that, but anyway, and I've talked before about putting 20% in USOY or GDXY to have some kind of uncorrelated option income, because gold and oil, even though they're both market related too a little bit, they're somewhat less correlated. And also I could say TLT, W. I know a lot of people don't like that, but just going for an income. So I'm probably going to be making big changes to the portfolio here in the first quarter of this year. I've been doing a lot of research in Portfolio Visualizer, and I've shared a bunch of it with you guys. Basically, I'm trying to figure out if you can efficiently hedge, these portfolios, and I found out yes and no. So anyway, but if you guys don't have any questions, I was just going to check in, and I have an idea. I don't know if you've seen my an AIPI, LFGY. I mean, I don't know on AIPI. I probably have enough exposure to that if I had YMAX, ULTY, and feet to that type. I mean, not exactly to that, but you get some AI exposure in there. I mean, check this out. Okay, let's go back to the Ultiverse, and then let's go back to LFGY. So, basically, well, that's how much everything was up and down. But look at the allocations. 15% Coinbase, 15% MicroStrategies. Nothing wrong with that. That's great. But so, if you have this fund and you have feed at the same time, that's you have some overlap there. Not that overlap's not, not good, but I love all these little ones that I don't know about that I do need exposure probably to Hive and NU, whatever NU is. Let's look and see what NU is now. I just want to make sure that you guys didn't have any pressing questions, but I want to check and see what NU is. Then I'm going to talk to you guys about a back test scenario really quick. It's kind of a follow-up. I bet you guys watched my show today, my back test today, and it's kind of a follow-up to that. And it has to deal with income and can you really live off that? So I think you guys will like that. So anyway, what in the heck is NU? Then we're also going to look and see when is JP Morgan's earnings. Have they already happened, or are they happening maybe in the morning? Maybe it's before the bell. I thought it was after the bell today, but all right. NU Holdings out of the Cayman Islands. I mean, let's get a chart of it. I mean, it's in mean reversion territory. It looked basically very similar to the chart of the Russell, or somewhat similar. I mean, they came down here and bounced. So we'll check out JP Morgan and BlackRock. Now we've already looked at JP Morgan's chart. JP Morgan hasn't seen the 200 days since back in October of 23. They challenged it. It was a successful test, and they've been leading the market higher. All right, so it does say E down here. Let's click on it. I ought to know this. I'm sorry. So yeah, Wednesday. Okay, the dog's birthday got me messed up today. So it's anyway. It's Wednesday. It's fine. So now let's look at BlackRock. Oh, look at that one. That one's taking it on the chin lately. Wow. Okay. There, the dog's barking. It's her birthday. Jackson, we aren't going to start that, okay? No, sir. Okay, well, I wanted to, if it's all right with you guys, I'm obsessed with Portfolio Visualizer because a lot of the stuff that I've been saying for a year and a quarter has been based on my experience, my feelings, but sometimes where I can, I've tried to do a back test or find out where somebody's done a study or a white paper. But now that some of these funds have been around for a couple of years, like Tesla has some pretty good history behind it. Tesla, ORC, some of these have been around. JEPI is starting to get some data. We're starting to be able to get some data where we can put some scenarios to the test. Because I get the question all the time. Yeah, these are great, Max. How are they going to do, in 2022, or how are they going to do in 2008 or whatever? So I really love the back test because I went back to August 2018. I know that's not super far, but anyway, I like that. But there's one thing we were talking about, the livability off of it. I'm always going down here. I'm saying, why do we do these? And I'm always just rubbing it in, or not rubbing it in, but just making sure everyone realizes you wouldn't mess with QILD, I don't think, unless you needed income. Because, it does give you a little diversification or whatever, but there's better ways to get diversified. But the problem with this portfolio is, even on it, it's a good news, bad news with these portfolios. The good news is, the bad news is, on $1 million, the income's not enough to live off of the first 5 years. So I'm always going, well, this, maybe if you're in early retirement, you have a job, maybe you can get your wife to get a job. I don't know. You know what I'm saying? Or lots of people have other money, and maybe they have a rent house, or they have a pension, or there's other situations. But you could live off this, except for, you aren't going to make it off $12,000. But you don't have to just spend $12,000. We can put it in the portfolio visualizer to where we're going to have to sell a teeny little bit of stock, but we can tell them how much to pay us. So let's say we're going to live modestly in retirement. But let's say we can live $50,000 a year. And I know Portfolio Visualizer doesn't figure taxes. So we're going to put in 60. And I know that's not a lot of taxes, but if you're just making $60,000 a year in retirement, you aren't in the, you aren't in the 90% tax bracket or anything. So anyway, we'll try to make it somewhat realistic. So we'll break it down to month, but I thought this was interesting. I think you guys that are doing these tests with me might be interested in here. You go to settings to set this up. We're going to leave the $1 million. You can also put in there if you're adding money. Let's say you have a rent house that's cash flowing $500 and you're adding, or you got divorced and he's paying you or she's paying you, whatever, and you have money coming in. You can look at these scenarios and put in where you're adding a fixed amount or whatever. But anyway, we're going to do withdrawing, but not a fixed percentage. I've done that before. We're just going to do a fixed amount, and we're just going to say 60,000, and we're just going to be all right with that. We're just going to have to be all right with that. So in the first couple of years, we're going to have to sell stock, but then as the portfolio grows, that's what I'm trying to show. I don't believe we'll really have to, because if you saw the video today, the guy was making $100,000 a year 8 years later, just with a simple, pretty conservative allocation. Anyway, so we're going to say withdraw fixed amount, and we're going to do amount inflation adjusted. Sure. And we're going to do it monthly, and withdraw fixed amount. Okay. Withdraw amount. So monthly. So I said, we're going to withdraw 6,000 a month, but 6,000 is 72,000 a year. Wait, so we'll do 1,500 a month, right? All right. Inflation adjusted, rebalance monthly, leverage type, none. We have a little leverage because we use some triple Qs sometimes, but no portfolio leverage. Okay, so other than that, if you saw my scenarios today, we're going to keep the scenario the same, but let's just give this guy a little cash to live off of, and let's see how much that affects his return. And I bet it doesn't. I bet he's still going to do fine. So this is the base portfolio: 80% Qs, 20% QILD, and I've always said no more than 20% for income. Just kind of like you would use a little bonds, 20%, 40% bonds or REITs for diversification for income. Same thing, no more than 20. Well, this shows you how you would have done if somebody would listen to me 8 years ago and done just 20. And 20 is kind of 20 may be a little too conservative too. But anyway, so if you did it and you withdrew the money, unfortunately, your return was a little bit less. The last return, I should have saved it before. It was returning 15 or 16 or something. But this way, you're having to, you're taking some money out. So, but not that bad. But anyway, let's see how Portfolio 2 did. Portfolio 2 had a low leverage. We didn't like it before. So, yeah, 7.4%. you know, it's has too high of a drawdown. But anyway, portfolio 3 though was really interesting to me. Was 40% triple leverage Qs. So that's, you know, that's great for bull markets. But then 40% Dorsey Wright, a short fund, which, you know, anyway, that's your, we're trying to make our own long short portfolio. We're long, we're short. And then we have 20% QYLD for income. We have 20% QYLD for income in all of the cases. I thought this one was the best looking portfolio. And it got 7.1%. They're saying to beat the benchmark by 0.9%. And I think that's because I think these returns are still good. They're just less than today's return because we're taking some of the return as cash. We're getting paid $50,000 a year. So that's why the returns are less, but that's fine. It's still showing us beating the benchmark. So what I'm thinking is they're also factoring in if you just had the index and you were selling the index. I think that's an apples to apples comparison. Because in other words, portfolio 1, which is our base model, the way I did it before in the last video was making 16%, and it was beating the benchmark by 3% or something. And it was similar on this. It was actually the maximum drawdown was 30, standard deviation was 19. But the difference is because the difference is 4.5, but we're taking, you know, we're drawing a little bit of cash from the account. But anyway, but let's go look at that. So, you know, but all of these funds, this one beat the benchmark. This one beat the benchmark. So these are all respectable. I just don't like these higher drawdowns. But anyway, that's fine. Let's look at, if you look at Sharpe and Sortino ratio, Fund 1 wins, hands down, beats everything. That's good. That's at 80-20. That's that old 80-20. If we look at annual returns, this is pretty interesting. I mean, this is like a buffer report going back to 2018, 2019, 2020. You can see they all lost about the same in 2018. The one that I had all the leverage on, B, lost the most, and we would expect that. They even lost more in the market. But in any event, then of course B, the next year when the market was up, B was up the most. That's the way leverage works, of course. But this Fund 1 is a good mix. I mean, because it beat the market there. It was the same as the market there. Beat the market pretty badly there with no leverage also. It tied the market there. Beat the market on the downside there. But it didn't, I mean, or lost to the market on the downside. But it didn't lose to the market on the downside as bad as those two funds did. As long as it's, you know, the more risky allocations. I still say C is a decent allocation too. But A or C. I keep calling it 1, and then I keep calling it C. It's 1 or 3, A or C. You get what I mean? I shared this before in that last video. Hopefully you guys have this file already, and you've already probably messed with it. But I just thought it was interesting. I didn't know if you could go in there and put that for them to give you a certain amount of income, and it'll factor that in, and it'll show you how much you're hurting your returns. And you know what? And it looks like, just eyeballing it, looks like we've hurt our returns about 5%. Well, how much income are we taking from our account? About 5%. So well, that makes sense, right? I mean, you know, that money doesn't come from nowhere. There's no free money. But that's why that standard, or that's why that the highest drawdown was 34, but in the old way it was like 30. The 4%, that's the difference. It's just the difference. But you know, look at portfolio 3. Portfolio 3 beat everything. I mean, beat the underlying there. It beat the underlying there. Lost the underlying there. Lost the underlying there. But spanked the underlying there and there and there. I think portfolio 3 is legit also. So, but there's a way to solve it, and I had it on the video this afternoon. There's a really cool stat on here. We're going to go down here and find it. We're going to go straight to it, as a matter of fact. It's called, it tells you how long you could withdraw from this fund, what amounts you could withdraw. You've heard of the 4% rule. It's the perpetual withdrawal rate. It's just a stat. I'm not saying do this, but it's just a stat. But the higher the stat, the more stout your allocation is. I challenged somebody to beat mine, and I think I had an 11.5% or something. Anyway, all right. A is pretty stout, and that's even includes taking the 50,000 out, paying yourself 50,000 cash out of it. You could still, even though you did that, you could do that, and you could get more. You could get whatever 10% comes to. So you could withdraw. They're saying you could withdraw 100 a year. Anyway, the other ones aren't as good, and my portfolio C that I like so much, they're at, if you look at this stat, it's not as good. Okay, let's go to income though. The income's the reason we do QILD in the first place. What we're basically trying to do is see if a person could use these covered call funds, if these are real or if they're BS, but can a person use these to retire over the course of 5-10 years? Will it erode their account to death? I had to put rebalance monthly in here, and the rebalance monthly hurts your returns. I forgot to set it at first, and my returns were really, really good, but you have to rebalance these funds pretty often. If you don't, the returns in here are unrealistic, especially if you're using leverage funds, which I do a bunch in here especially. Okay, so like I say, the only reason we do this is for income. So here's the income. So here's the income the portfolio generated. It's not what they paid you. Hang on. Well, I guess they don't show you what they paid you. Okay, that's fine. Okay, well, income. So this is interesting too, though, because what they're paying you has to come from somewhere. Okay, they portfolio A, the 20% QILD, that made $12,000 in year one. In year two, it made $26,000. It's because the account's growing. This total return does really count. Rising tide lifts all ships. As the account gets bigger, the yield, the return gets higher. But anyway, by year three, your QILD was earning 32,000. Year four, it's earning 44,000. But those were some good years in the market. Not 2018, but 2019, 2020, and 2021 were great years. 2022, not such a good year, and your income went down because your portfolio balances went down. All right. But in any event, you ended this with a pretty good income. Portfolio A's, 50,000 a year. That's what you're making from the dividends from the Qs, which isn't very much. But you have $1 million. You have $800,000 worth of Qs. So I mean, it's not nothing either. But then the main thing that's driving the income is the 20% allocation to QILD. Well, if you look, what's happened when you put these returns together and the way compounding works, even when you have a really bad year in 2022, and even when all three strategies outperform the market on the downside, you can grow a portfolio. So this portfolio that starts at $1 million, by 2020, it was at 1.4 to 1.3, and then by 2022 the balances were 1.4, 1.5, 1.6, and 1.7, and of course they came down in 2023. I mean, there's no free money, but then as the balances go up again, then by 2025 these portfolios, the highest one was at 1.7 million, but that and they've been giving you $50,000 cash. Or whatever I put in there, $6,000 a month. Yeah, so it's $72,000 a year. It's been paying you $72,000 a year, and that comes out of the returns. They showed that somewhere, but in any event, I think it's encouraging how much the portfolio income grows. It's also somewhat interesting to me that that by 2024, portfolios 2 and 3 have such a higher income. But any event, this is interesting to look at. This is what would have happened if somebody would have retired 8 years ago. So somebody that's retiring now, of course, it's you might hit 3 bad years in a row. I mean, that's one other thing I was going to say. I didn't make the point today, but I wanted to make the point about the perpetual withdrawal rate. Then I'll take questions and I'll just take questions. We'll see what's up. But the perpetual withdrawal rate, I'm equating that to the 4% rule. And the 4% rule is based on the same thing. It's based on a similar stat, I believe, and just an average kind of rule of thumb type thing. Well, when you look here, right here, okay. Perpetual withdrawal rate. If you look all the way to the right, this is the index, which is the Vanguard 500 total market index or something. So the perpetual withdrawal rate is 8. Well, that's 8. That's how much you could have done over the past 8 years. The optimum, now the next 8 years may not be like that, and so that's why I think investment advisors tell you 4. Or tell you, as little as possible. You try to do 3 if you can, but 4, and that's in case, because 8's higher than average probably. So in any event, but 8 is what you could have actually done just being in an index without any yield funds. But if you were in the Qs plus 20% of a yield fund, you could have made some return and actually grown some wealth. You didn't kill your wealth. That's what I was trying to show. And I mean, over these past 8 years, there was enough left in there for you to grow some wealth, and you even grew your income a little bit as your wealth grew, which I thought was interesting. And that's in QYLD. And we all know that QYLD to a lot of us is one of the less interesting funds. Just, it's just one of the more low powered ones, but it's very steady and it has a lot of data on it. So I thought this was an interesting test. I just wish I would have screen captured the returns before I put in the withdrawing, but they were making, all those plans were making 15, 16, 17%, but because you weren't taking cash out. As soon as you start withdrawing $6,000 a month, it's still good that you can do that, and they were still beating the underlying. But yeah, this is more like what they were. I opened a different page that I hadn't done the withdrawals yet to, and here's one that where you aren't taking withdrawals. It's a variation on portfolio one. You're making 18%, you're making 13%, and you're making 16%. So here, let's just go add in the withdrawals real quick. It's now I know how to do it. You just put in cash flows, withdraw fixed amount, withdraw amount. We're going to do 6,000 because it's a month. Inflation adjusted, yes. Initial amount cash flow calendar. Oh, annually, no. Monthly. Okay, so now let's go see. Yeah, the return went from 18 to 11. Still beating the benchmark. I should have remembered seeing what these are, but I bet these went up by about 5%, or the drawdown went up by 4 to 5%, just because you're also, in addition to everything else, the fund is also paying you an income. It's like it has you to support now too, so that comes out of return. Anyway, let's see if you guys have questions. I appreciate you all for being here. Yeah, I don't know on AIPI. I mean, but if I could ever get my stuff together, What is lots of hoax for diversity and Jay advices what that? Oh, okay. Yeah, so GAIX is interesting. I need to put GAIX in the buffer report. We probably need to start looking at that. Does anyone have that? I mean, it's interesting. XVol is interesting too. If you want to talk about, but yeah, that's an interesting fund. Anyway, CJ, I appreciate you for being here. I appreciate you for contributing. Michael Anthony, what are you doing here, Michael? Let's see here. MFA rebounded with the book value of 1842, which rebound with upgrades over $11. Wow, that's impressive. That's impressive. What's going on, CJ, folks, on your YieldMax page, dumping FEPI? Well, for when I first got in this business, that's all anyone could talk about. They love FEPI. And FEPI was and is a great fund. I don't know if it's gone bad. People used to love SVol, and somebody in our Discord was trashing SVol the other day. And I don't care. We have a free speech. I mean, I really am a free speech absolutist. It doesn't matter if I agree with you or not. But yeah, it was just talking about all the erosion and stuff. But I don't know. Maybe I could see maybe SVol isn't the SVol it was a year ago. But a lot of funds aren't. That happens. But maybe that's happening with FEPI as well, because FEPI used to be a darling. Yeah, underperformer. I figured that happens. I mean, it happens. Unfortunately, it happens. Let's look at charts a little bit. I wanted to see that. Do you guys think this is a viable dip? I mean, what I'm talking on now, we're on daily patterns or daily bars, but this, I like this kind of 3-bar reversal pattern, especially if it's down on support. Doesn't always work out. We had one right here and it didn't really work out, but sometimes they work out tremendously like they do there. Anyway, it's something that I look for, but I don't know. So let's look at the tiebreaker here. To me, what's really been weighing on the market, and I wanted to show this to you guys, is the 10-year yield. 10-year yields have been going up, and yields go up. It's pressure on the market because it's taking liquidity out of the market. But the good news is, though, yes, yields have been going up. They're up here right close to the top band. It's possible they could do this and they could start a trend like they did last year in August of 2023. Boy, that knocked the market down in September and October of 2023. I don't know if you remember October of 2023. Real fast, real quick pullback, and it's because of this. Anyway, but if we'll mean revert. And that means if yield would come down, boom, then that would be less pressure on the market. And then maybe the SPY would turn around. And it may turn around anyway. It is probably fine. So let's look at another thing that's maybe keeping a little pressure on the market is the volatility. Here's a daily chart of volatility, or one measure of volatility. And today's bar is going the right direction. It's going back down. Down is good, but if you look back at the general trend is pretty much up. And even if you look back at the 200 period moving average is sloping up. So anyway, that to me, that's kind of weighing on the market, or there's that it's hard to go. It's hard for the market to go up. In fact, I think the path of least resistance is down whenever people are buying volatility. I mean, until it hits a low. So maybe that's what it did today. Anyway, I'd like to know what you guys think. Do you think we're at a low on the daily chart? Could you buy it today and do a trade? And is yesterday's low a tradable bottom? I mean, that's all I'm saying. That's all. I'm probably going to say no, even though I want to. My heart says it is, but I think probably because of what we're seeing in the volatility with the whole movement, probably maybe not yet. Maybe we have a little bit further to go. Anyway, what's up, Carl? How you doing? I appreciate you being here. I'm glad you're here. Don't worry about being late. Not really so much sticking with ULTY. ULTY meets what I want it for, but I'm not a trader. I'm a yield guy, and so yes, ULTY's 20% right now, but it may not be for everybody. And if you want yield, but you want some degree of safety, we have something for you. It's called the Z factor. And so these are the best funds out there, according to this one metric that I invented. And I'm not a data scientist. It's just, but I've been doing this a long time and I like this metric. But anyway, according to this one metric, these are your safest high yield funds. So the ones I measure, the ones that have been around for at least a year: NFLP, NVDY, SCHG, CLN, AMZE, XVOL. The triple Q is not really high yield. Of course, it's safe. SPY, InFly, though. I mean, so you have some good ones on there. Those are the ones that like if you really want true safety. Now, some people don't care about safety. They said, no, I just want the ones that are going to have that are hopefully going to double in a year, and I'm hopefully going to have my money back. Even though that doesn't always work, but I mean that there's people that are playing for that strategy. Well, that's fine. So, in my opinion, these are the ones you'd want: NVDY, Coney, InFly, FIBI, AMZ, AMD, PI, IWMY, NFLP. Anyway, I think these are the all-around ones that I like the best. But yes, for me, and I know ULTY isn't on here, but I just like what ULTY does. And it pays a lot of income, but it's super volatile, and it has a lot of NAV depletion. You understand how NAV depletion works. There's erosion's a misnomer, or erosion's a real thing. It doesn't really happen to these covered call funds too much. It happens to other funds a lot. But something that does happen to these covered call funds a lot is NAV depletion. I know it's just one difference in a word, but it makes a big difference. The NAV depletion is the dividend coming out on X day or whatever. So when you're paying 100% a year, what is that, 7% a month or so, or 8% a month or something, that comes out of your NAV. So that's one problem, and that's its own problem. I'm not saying that's not a serious problem. That is a serious problem. That's something you have to factor in. But anyway, yeah, so I like ULTY. It works for me, but it's definitely not for everybody. And super risky. And if you got in it and you're wondering why, and it's making you mad, and maybe you shouldn't be in it. But talk to your planner or whatever. There's lots of funds out here that are similar, that sell covered calls that might be more to your liking. If you just want super safe, I mean, iSpy, it's a great one. JEPI, it's a great one. Now what's going on with the SVOL? Yeah, I know somebody in SVOL was talking about that SVOL's, not doing well. Seems like they've cut their dividend. That's what somebody in Discord was saying. They've cut their dividend and they have more NAV, or they were saying they have more erosion lately. But I think what I think it is this. I think if you have to understand how the market works, so you guys all understand this, I know, but this is why it's under pressure. Or because they're shorting this chart on a daily basis. And look at the moving average of this chart. Even the moving average since August, the moving, volatility has been going up steady since August. I mean, yes, Trump's election helped and volatility came out for a little while, but then it went right back in. So this is why SVOL is doing poorly lately. If we get in a phase like November of 2023 for, till March of 2024, it'll be doing fine again. It's under pressure because the market's under pressure. And specifically, they short volatility, and volatility has been lit lately. I'm not worried about SVOL particularly. But unless I'd have to hear more about it than it's just, but yes, that probably is why people are selling it or whatever. And this isn't a pitch for SVOL, but I mean, these funds do exactly what they're designed to do for the most part, I think. Let's see what's going on with this one. Is Marnie getting interesting to you yet? It seems it can only go up from here. Underlines. Well, I don't know. Still one of the biggest drug companies, but with the administration that's coming in is not going to be friendly at all to that type of business. I don't think. But yes, maybe the bad news is already in, and it's at the bottom. I have no idea. With me on these, that's why I try to show you guys these allocations. I like the index ones, and so with me, that's why I like ULTY, because it's an index. There's 20 stocks. It can't get hurt by any one stock going down. So for me, for me, no, Murray's not for me, even at this low level. But it's part of WiMAX. I have WiMAX. I hope Murray recovers, as far as it being part of WiMAX. But yeah, now if you've had it for a long time and you're thinking of selling it, or I have no idea on that. I mean, but my general advice on these would be, I try not to trade them, to allocate them. So commit for like a year and commit to a percentage of your portfolio. Okay, I'm going to do 20% for a year. Maybe look at it after a year, or maybe if it's not paying you as much yield as you wanted or something, then, if they change their prospectus or something, then I might sell it. But, just because the underline's down, that's really not the yield fund's fault. I mean, to me, it's anyway, but it does suck to get in one of those. One of the worst funds, people were so mad at Tesla, and I'm not saying to hold on. People that did hold on to Tesla were rewarded handsomely. Let's look at this really quick. Last year, I was on a podcast with Mike, the tactical stock scalper, like last March, and he asked me my stock pick, and I didn't have one. I'm not a stock picker, as you guys know. It was back around here somewhere. And I said Tesla, but only because it was down so much. I think I heard that it was down the most out of the S&P 500 in 2023. It was down the most. So I just figured from a mean reversion standpoint, it would, so that turned out to be a great pick. But anyway, I didn't tell anyone to buy Tesla though, but if somebody had held on to Tesla through all that, I mean, let's look at a Tesla chart really quick. Let's take off dividend. I hate to take off dividends, but we'll take off dividends. It's really kind of meaningless to look with taking off dividends, but okay, with taking off dividends, you can still judge the general trend, and when it hits the bottom line, it's generally a buy, and when it gets to the top lines, all right. But let's put the dividends back on, because this includes how much your bank account's growing also. So really, if you bought this at the beginning, bank account wise, it was around 7. Now it's around 13. You're doing pretty well. Just as far as your investment. This is your overall investment. The other chart is the NAV of Tesla, but this is the NAV of Tesla plus the growth of your bank account. Anyway, but yeah, I don't know on ULTY. I like it just fine, but it's definitely not for everybody. Well, Carl, you're certainly welcome. Don't worry about being late to the party. And I wish I had an answer for you on this, but if it was me, I would just, like I said, I would go get QDTE, Triple QY, or FEPI, or WiMAX, or one of those. There's safety in numbers, right? I mean, that's what I figure. If I load up on any time I get one stock, it's always the one that does bad the next year. Now, granted, I did just get a couple of single stock ones of these, but they make me nervous. I got NVDY, AMDY, AMZY, and Sky. Those are all pretty good. But still, though, I probably should have just got WiMAX and FEET and called it a day, right? It's all the same stocks. Maybe throw in some ULTY just for a little fun and excitement. Anyway, I have more back tests coming. I hope you guys like the back test content. I'm going to have another back test coming out tomorrow. I got a comment from somebody that wanted me to test a particular for them. So I'm going to put the number they wanted in. I think they want me to look at a different fund or something. Anyway, I'm going to run that, and I'll make that video tomorrow. But I appreciate you guys being here and asking me questions tonight. And I'll be back in the morning. All right, guys. I'll see you later.